Please like, share, and subscribe. Wishing you happiness and good luck every day.
So, how are you supposed to invest when the world just feels completely unpredictable? I mean, one day the headlines are screaming about the next big crisis, and the next, it's all irrational exuberance. It's a challenge we all face. But what if I told you there was a playbook, written way back in 2009, whose principles are just as powerful today? We're going to dive into the core strategies from Dr. Bob Froehlich's A Bull for All Seasons and see how some timeless thinking can help us navigate pretty much any market.
You know, Dr. Froehlich kicks off his look at the economy with this brilliant quote from John Kenneth Galbraith, and it just perfectly frames his whole philosophy. The goal here isn't to get a crystal ball and predict what the market's going to do next week. I mean, we all know that's a fool's errand. Instead, real success comes from understanding the massive, powerful forces that are already in motion, the ones shaping our world right this second.
So I want you to think of this as an investor's playbook. Dr. Bob's entire approach is about shifting your perspective, getting away from the frantic day-to-day noise and instead focusing on just a few core principles that give you clarity and conviction no matter what the market is throwing at you.
And this is the central metaphor he uses, which I think is just fantastic. Forget about the little ripples on the surface of the water. It's the giant, slow-moving icebergs underneath that have all the real power. Dr. Froehlich argues that investors get into a world of trouble when they react to every single headline. The smart money, he says, is focused on a handful of these deep, structural trends that are fundamentally reshaping the global economy for the long haul.
Okay, so let's crack open this playbook. The first two plays are absolutely foundational. They're all about seeing the real forces at work and, just as importantly, avoiding a really common, really costly mistake about where the real opportunities are. So here they are, the four icebergs as he saw them back in 2009. First up, you've got productivity and technology, which are really two sides of the same coin, right? The tech revolution wasn't just about some dot-coms. It was about fundamentally changing how business gets done. Third, global free trade, which just exploded after the fall of the Berlin Wall. And finally, demographics. Now back then, the big story was the 76 million baby boomers hitting their peak earning years. Today, you might be thinking about the economic power of millennials or the rise of a global middle class, maybe the impact of AI. The specifics might change, but the principle? That stays exactly the same. These are the deep currents you have to be watching.
All right, on to the second play. And this one's a big one. Around the turn of the millennium, everyone, and I mean everyone, was obsessed with this idea of an old economy versus a new economy. It turned out to be a classic trap that a lot of investors fell right into.
So the myth, the story everyone was telling themselves, went something like this. The old guard, your car makers, your airlines, your retailers, they were all just dinosaurs, totally doomed to go extinct. And the only thing that mattered were the flashy new dot-coms. It was this simple binary choice. But that was a massive, and for a whole lot of people, a very expensive misunderstanding of what was actually going on.
Because the reality, and this is Dr. Bob's crucial point, is that the real magic, the true investment opportunity, wasn't about choosing one over the other, it was in their fusion. The biggest winners were the old economy companies that figured out how to use the tools of the new economy to get more efficient, reach more customers, and, well, make a lot more money.
And this example just nails the point perfectly. Take Southwest Airlines, an old economy company, right? Of course. But as Dr. Froehlich points out, they totally embraced a new economy tool, the internet, to sell tickets directly to people. More than a quarter of their revenue was coming straight from their website. That's not a dinosaur. That's a predator that just learned a brand new way to hunt. Okay, so let's build on that. Let's move to the third play and see how this all connects. Once you get the power of technology and this idea of fusion, the next logical step is to start looking beyond your own backyard for growth.
The third principle is so simple, but so powerful. Go global. It is incredibly easy to get tunnel vision and just focus on your home market. But as Froehlich hammers home, capitalism and growth, they don't care about borders. While one market might be struggling, others could be right in the middle of a historic boom. And this slide, wow, this really just drives the point home with data straight from the book. I mean, look at this contrast. While the US market was actually down for the year, you had markets in China, Hong Kong, Brazil, Spain, all posting these incredible double-digit returns. It's such a stark reminder that if you're only investing at home, you could be missing the biggest party.
Okay, so we've seen where some opportunities might be, but let's talk about one of the biggest factors in how much of those gains you actually get to keep: taxes. Dr. Froehlich takes this incredibly complex, often politically charged topic, and he explains the dynamics through a simple, really memorable story.
It's called the parable of the 10 men and the beer. And I'm telling you, through these 5 simple steps, it offers a powerful lesson on tax cuts, on fairness, and on how our perception can sometimes lead to some pretty disastrous, unintended consequences. So here's the setup. Every single night, 10 men go to a bar. The total bill is always $100. They all agree to pay the bill in a way that kind of mirrors a progressive tax system. As you can see, the first 4 guys, the poorest, they pay nothing. 0. The next 5 pay on a sliding scale. And the 10th man, the richest one, he pays the lion's share, $59. And at this point, everybody is happy with the arrangement. It works for them.
Then one night, the bar owner's feeling generous. He gives them a $20 discount on their total bill. You can think of this as a $20 tax cut, right? The bill is now only $80. The guys are thrilled. But now they have a problem. How do they share this $20 windfall fairly?
So after some back and forth, they decide to reduce everyone's bill by roughly the same percentage. And as you can see on the slide, every single person who was paying before is now paying less. The 5th guy, he now pays nothing. The 6th man saves $1, the 7th saves $2, all the way up to the 10th man, who, because he was paying the most to start with, gets the biggest savings in pure dollar terms, $10. On paper, everyone is better off.
But then they get outside the bar and they start comparing their savings. And the whole perspective shifts. The 7th man shouts, "Wait a minute, why should he get back $10 when I only got 2? The wealthy get all the breaks." Suddenly, the focus moves from the fact that everyone is paying less to the raw dollar amount of the savings, and resentment starts to build.
And here, the story takes a dark turn. The 9 men, feeling like they've been cheated, surround the 10th man and beat him up. The next night, well, he doesn't show up. And when the bill for $80 comes, the remaining 9 men pull out their money and they discover they don't have enough to cover even half of it. And that, Dr. Froehlich says, is the lesson of the parable.
So all of this brings us to the final, and maybe the most important question of the entire playbook. It's not really about what the market does, it's about what you do. It's all about your own investment psychology. So, I want you to really think about this for a second. When the headlines are terrifying, when it really feels like a total market meltdown is happening, when everyone around you is panicking, what kind of investor are you in that exact moment? Dr. Froehlich presents this really powerful analogy. You know, in those old Cold War movies, you always see that close-up of a finger hovering over a big red button. Well, in a market panic, you have a choice. You can either be the finger, the one that acts proactively, strategically, based on a plan you already have, or you can be the red button, the thing that just gets pushed around by fear, by emotion, and by panic. And that is the crucial point. Having a playbook, understanding the icebergs, knowing about the fusion of economies, seeing the global opportunities, that is what gives you the conviction to be the finger. It allows you to act with confidence when everyone else is just reacting with fear. It is the difference between being in control and being controlled. And that leaves us with one final kind of provocative thought. As Dr. Froehlich reminds us, there was a time when all the smartest people, looking at all the available data, were absolutely certain the world was flat. So the question he leaves us with, and the one I'm going to leave you with, is this. What widely held market belief, what accepted truth of today will investors of the future look back on and see as the flat earth of our time? All right, today we're going to do something a little different. We're going to jump in a time machine and head back to the turn of the millennium. Why? Because this was a time when the entire economic rulebook was basically torn up and thrown out the window. And if we can understand what happened then, well, we can learn how to spot those moments when the rules are changing right under our noses today, and how to see past all the noise in the headlines. So, let's get into it. You know, this quote from John Kenneth Galbraith, it's just perfect for kicking things off. It's a fantastic reminder that what we think of as economic truth isn't always set in stone. To really get what's going on, you can't just listen to the forecasts. Nope, you have to dig a little deeper. You have to question the assumptions, and you really have to figure out the real rules of the game. Because as we're about to see, sometimes those rules get completely upended. So, here's our roadmap for today. First, we'll take a quick look at the standard economic dashboard. You know, the numbers everyone watches. Then we get to the really fun part, seeing exactly why the old rules just stopped working.
We'll dive into the mystery of the inflation that never showed up, and we'll ask a pretty big question. Are our economic gauges themselves broken? And finally, we'll talk about how to focus on the icebergs, the real, game-changing trends hiding in plain sight.
Okay, so before we can talk about breaking the rules, we kinda have to know what the rules were in the first place. Let's start with a quick look at the main dials on that economic dashboard. These are the numbers that everyone, and I mean everyone, is obsessed with.
First up, you've got the big one, gross domestic product, or GDP. Just think of it as the ultimate economic scorecard for a country. It's the total value of, well, everything a country produces in a year or a quarter. So when you hear on the news that the economy grew or it shrank, this is the number they're talking about.
So what's the engine behind all that GDP, especially here in the US? It's us. It's consumption. It's our spending. And it makes up a staggering 2/3 of the entire American economy. I mean, that's huge. And it's exactly why things like consumer confidence get watched so closely. Because if we get nervous and stop buying stuff, the whole economic machine can really start to sputter.
And finally, there's unemployment. Now, the official definition here is absolutely key. You're not just counted if you don't have a job. You have to be actively looking for one. It's a number with enormous political and economic weight, but as we are about to find out, that neat, tidy little definition can be incredibly misleading.
Okay, now for the main event. In the late 90s and early 2000s, two massive forces, technology and globalization, came along and completely rewrote the economic playbook. The old rules of thumb, the ones that had worked for decades, just suddenly started to fail. Let's look at three big ones that got tossed right out.
Okay, take the savings rate. The old rule was pretty simple. A high savings rate meant there was more money in the bank for future investment. Made sense. But then, the economy shifted from making things to providing services. And all of a sudden, people weren't getting a little bit of overtime each week. They were getting these big lump sum bonuses at the end of the year. And that money, it didn't just sit in a savings account. It flooded into the stock market every January. And just like that, a once reliable indicator became pretty much useless overnight.
Now this one is fascinating. For years, you could basically judge the health of the entire economy by counting how many Barbie dolls were sold at Christmas. Seriously. But then our behavior changed. We started giving plane tickets or weekend getaways or concert tickets as gifts. And these experience gifts, they don't show up in the traditional retail sales numbers. So that old barometer, it just got less and less accurate.
All right, now this one broke one of the most sacred laws of economics. It's the idea that super low unemployment must lead to higher inflation. For decades, the logic was ironclad. If there are fewer workers available, they can demand higher wages, and that forces companies to raise their prices. But globalization changed everything. In a global marketplace, if US workers demanded too much, a company could just pack up and move production somewhere else. And this new reality, it put a powerful lid on wages and inflation even when unemployment was hitting record lows.
And that leads us right into our next big topic. For years during this period, economists, especially the ones at the Federal Reserve, were absolutely terrified of inflation. They kept seeing what they thought were signs of it, they kept warning about it, but it was a phantom. The inflation bogeyman they were looking for under the bed just wasn't there. So why not? What was going on?
Well, it wasn't just one thing. It was a powerful combination of long-term forces all hitting at once. Like we just talked about, the global economy created intense competition that kept a lid on prices. The tech revolution led to this massive productivity boom, which let businesses produce more stuff for less cost. A strong US dollar made all the goods we imported super cheap, forcing our domestic companies to compete on price. And finally, the launch of the euro created a huge new economic bloc in Europe, which just increased competition even more. These weren't temporary blips. These are fundamental, long-term shifts in the global economy.
But what about the counter-arguments, right? I mean, in 1999, for example, gold prices shot up, and all the old-school economists screamed, "See, we told you, inflation is here," but they were totally misreading the signal. This wasn't people dumping their stocks and bonds to buy gold. No, that price spike was driven by two very specific things. European central banks decided to limit their gold sales, which squeezed the supply, and you had a few people buying gold coins because they were worried about a Y2K computer meltdown. It was a classic supply and demand blip, not a real sign of runaway inflation.
So, the old rules were broken, and the old signals were giving false readings. But what if the problem was even deeper than that? What if the very instruments we use to measure the economy, the dials on the dashboard, what if they were broken too? This is where we explore the idea that the data itself might be telling us a very misleading story.
Just look at this number, 684,000. What is it? It's not a forecast. It's not a prediction. It's a mystery. It's the number of jobs that simply disappeared from the official government reports in just 9 months.
So here's the puzzle. In the first 9 months of 2005, the U.S. government put out 2 different reports on employment. One of them, the one that gets all the headlines, said the economy created about 1.6 million jobs. But the other survey said the economy created almost 2.3 million jobs. That's a difference of 684,000. So, which one was right? And where in the world did all those missing jobs go?
Well, here's the problem. The report that gets all the attention, the payroll survey, gets its data by talking to 400,000 established businesses. But think about what that misses. It misses the self-employed, brand new startups, independent contractors, basically the entire engine of the so-called new economy. The other report, the household survey, actually talks to people, to households, and it does a much better job of capturing all these new ways that people are working. So the headline number, the one everyone was reacting to, was systematically blend to a huge part of the real job market.
And this wasn't some new problem either. I mean, look at this chart. This is from the 1990 census. Officially, unemployment was low, sure, but look at that massive slice of the pie. Nearly 50 million healthy, able-to-work adults who weren't counted as employed or unemployed. They were basically invisible to the official statistics because they weren't actively looking for a traditional job. This huge hidden labor pool was another key reason why wage inflation never really took off. The labor market was just way, way looser than that headline number ever suggested.
Okay, so if the old rules are broken and the data itself is misleading, what's an investor or really anyone trying to make sense of things supposed to do? Well, this final section offers a new framework. Stop chasing the daily noise and learn how to identify the massive, slow-moving trends that truly shape our future.
You know, I absolutely love this metaphor. Think of all the market news you hear as either a blizzard or an iceberg. Blizzards like that California energy crisis back in 2001 are intense. They dominate the headlines, they create a ton of panic, but they pass. Icebergs, on the other hand, are these deep, powerful, slow-moving forces, things like the technology revolution or major demographic shifts. They might not make headlines every single day, but they are the trends that will fundamentally shape the market for the next decade. The real key is learning to tell the difference between the two.
Here's a perfect example of an iceberg-level trend for you: employment. It doesn't just happen out of thin air. It follows a really predictable cycle. First, the economy has to grow. Then, that growth has to turn into actual corporate profits. Only after profits improve will businesses feel confident enough to start spending and investing again. And only after all of that, as the very last step in the chain, do they finally start hiring people. Jobs are what we call a lagging indicator. Understanding this sequence helps you see past the short-term blizzard of a bad monthly jobs report.
So what were the big icebergs of this particular era? Well, here they are. The U.S. was actually running government budget surpluses, which meant more capital was available for the private sector to use. You had the tech revolution just driving incredible gains in productivity. Global free trade was opening up huge new markets around the world, and the massive baby boomer generation was entering its peak earning and savings years. These were the deep currents that were really driving the economy regardless of what the daily blizzards looked like.
So what's the ultimate takeaway from all this? The most crucial point is that economic rules aren't like the laws of physics. They're man-made, and they can and they do change. Real insight doesn't come from just memorizing old formulas. It comes from constantly questioning our assumptions, looking at the data with a critical eye, and trying to understand how the world is actually changing, not how some old textbook says it's supposed to work.
And that leaves us with one last question to think about. We've just seen how the entire economic rulebook of the 20th century was torn up and rewritten. So it really makes you wonder, what are the ironclad economic rules that we all believe in today that future generations are going to look back on as just quaint, outdated myths? Something to think about. Thanks for tuning in.
All right, let's dive into one of the most powerful, and let's be honest, one of the most misunderstood institutions in the world, the U.S. Federal Reserve. Now, on Wall Street, we just call it the Fed. And this is an organization whose decisions can literally create or destroy trillions of dollars in wealth. So today, we're going to pull back the curtain and break down exactly how this thing works. You know, to really get the Fed, you have to start with this classic quote. It is the perfect metaphor for its entire mission. Just picture it. The economy is this massive party. Everything's humming, the music's loud, everyone's having a great time. But if that party gets a little too wild, things can start to break. That's what we call inflation, when an economic boom leads to prices just running away from us. The Fed's job? It's to be the responsible adult in the room, the one who walks over and takes away that punch bowl of easy money right when the party's getting really good. It's all about preventing the painful hangover we'd call a recession. So here's the game plan for today. We're going to start with the basics of that punch bowl. Then we'll take a peek inside the machine, see how it's actually built. From there, we'll see it in action during a truly wild time in the markets, watch a critical changing of the guard, and then we're going to land on the single biggest reason why all of this really, really matters to you and your money. Okay, let's jump right into part one. What is the Federal Reserve, really? It sounds so official, so imposing, right? But at its core, its whole purpose is to be the foundation, the bedrock of the entire U.S. financial system. It's the institution that's supposed to keep the economic seas as calm as possible. Now, here's something a lot of people get mixed up. You might think, oh, the Treasury prints the money, and that's that. And you're not wrong, but you're only half right. The Treasury does physically print the cash, but it's the Fed's job to actually manage that money, to get it out into the banking system so it can flow through the economy. Think of it this way. It's the bank for all the other banks, and it's the bank for the U.S. government itself. Okay, so this is where it gets really interesting, how this whole machine is put together, because its structure is totally unique, and it's designed for one very specific reason, to be part of the government, but at the same time, to be shielded from it. This phrase right here is the whole ballgame, independent within the government. The Fed gets its power from Congress, sure, but its big decisions don't need a thumbs up from the president. The governors, they get these super long 14-year terms. Why? So they can think about the long-term health of the economy, not just who's going to win the next election. And here is the absolute kicker. It funds itself. The Fed makes its own money, mostly from interest on the bonds it holds. And what that means is politicians can't threaten its budget to try and push it around. That financial independence is the key to its political independence. So the system has three main gears. First, you've got the Board of Governors in D.C. They're like the central command, setting the overall strategy. Then you've got these 12 regional banks scattered all over the country, from Boston to San Francisco. They're the Fed's eyes and ears out on the ground. But the one you really got to know, the one Wall Street obsesses over, is number 3, the FOMC. This is the crew that actually votes on interest rates. It's all the governors plus a rotating group of the regional presidents. This is the meeting that makes the market hold its breath. So why do they watch so closely? What is the big deal? Well, it all boils down to 2 words: monetary policy. I know it's a fancy term, but all it really means is how the Fed controls the price of money. By making it cheaper or more expensive to borrow, their decisions send ripples through the entire economy. It affects everything from your car loan to your mortgage to the stock market. You could say it's the Fed's superpower. So how do they use that superpower? Well, these are their 2 main tools of the trade. On the left, you've got the Fed funds rate. This is the big one. Think of it like the wholesale price for money. It's the rate banks charge each other for super short-term overnight loans. The Fed nudges this rate up or down by buying or selling government bonds. On the right is the discount rate. That's the price a bank pays if it has to borrow straight from the Fed itself, kind of like a backup. It's usually set a bit higher. And you'll hear people on Wall Street throw around the term basis points. Don't let it intimidate you. It's simple. 100 basis points is just 1 percentage point. So 25 basis points is just 0.25%. That's it. All right, enough theory. Let's see how this all plays out in the real world, because that's where the rubber meets the road. We're going to rewind the clock and look at the era of the legendary Fed chairman Alan Greenspan. This was a time of just massive market swings, where trying to guess what the Fed was going to do next became the biggest game on Wall Street. Okay, set the scene. It's the summer of '98. And the market is in total chaos. The Dow had just had its second biggest single-day point drop ever. Panic was everywhere. And right in the middle of all that fear, the author of our source material makes this unbelievably bold call. He says the Dow isn't just going to recover, it's going to hit 10,000 by the end of the year. So what happened? Well, the market did have an absolute monster of a rebound. It finished the year up over 16%. But it didn't quite touch that 10,000 mark. And this is a perfect illustration of the challenge, right? You can be dead on about the general direction of things, but nailing the exact target is incredibly, incredibly tough. All right, now fast forward to June of '99. The Fed hikes interest rates, and our author, feeling pretty confident, basically declared game over. He said the fat lady had sung, which is an old way of saying this is the final act. The Fed was done raising rates for the rest of the year. And the result, well, as he admits himself, he was dead wrong. The Fed wasn't even close to being done. They hiked rates 2 more times that year. And this is such a critical lesson. It shows you just how seriously the Fed takes its independence. The market can be screaming one thing, but if the Fed's data is telling them something else, they will go their own way. This is that independent within the government idea playing out in real time. And just look at this timeline to see how wild it was. From 99 to 2000, you've got 6 rate hikes. Then, bam, in 2001 alone, they slammed the car into reverse and cut rates 11 different times. And then, after September 11th, 4 more emergency insurance cuts. I mean, this was not a gentle hand on the wheel. This was the Fed actively and aggressively trying to steer a giant economic ship through an incredible storm. So after almost 2 decades of that kind of volatility with a chairman who was famously hard to read, the market was ready for something different. And boy, did it get it. The Greenspan era ended, and a new chairman, Ben Bernanke, took the helm, and with him a completely new style. Wall Street called Greenspan Hurricane Allen, and now they were bracing for Hurricane Ben. And the difference between these two guys was night and day. Greenspan was famously cryptic. You had analysts trying to decode his speeches like they were ancient scrolls. Bernanke, he was a former Princeton professor who believed in transparency and just telling people what you were trying to do. He was a huge fan of setting a public inflation target, something Greenspan never wanted to do, so that everybody from Wall Street to Main Street knew exactly what the Fed's goal was. It was a massive shift in how the Fed talks to the world. This new, more academic way of thinking led to some really fascinating ideas, like this puppy dog analogy. Get this. Under Bernanke, the Fed was raising rates to fight inflation. Okay, makes sense. But a big chunk of that inflation number was coming from rent prices. And when the Fed raised interest rates, it made mortgages more expensive, which made it harder for people to buy a house, which pushed more people into renting, which drove rents even higher. You see? The Fed was basically chasing its own tail. The cure was accidentally making one of the symptoms a little bit worse. So, we've covered the what, the how, and the who. But now we get to the part that really matters to anyone with a 401k or a brokerage account. The why. Why should you care about all of this? What is the single most important takeaway from watching the Fed? Okay, I want you to look very, very closely at this slide because this is the secret sauce. This table lays out the 4 basic environments for the stock market. Number 1, the promised land, is obvious, right? Rates are going down, companies are making more money, everyone's happy. Number 4 is the worst. Rates are rising and profits are falling. But now, look at number 2 and number 3. This is the mind-blowing part. The market actually does better when both rates and corporate profits are falling than it does when profits are rising but interest rates are also on the rise. Just think about that for a second. So here it is, the big takeaway. In the short term, on a quarterly basis, the direction of interest rates is more powerful. It matters more to the stock market than the direction of corporate profits. Let me say that again because it's that important. The Fed's actions, what they do with the cost of money, can literally overpower how well the actual companies you're invested in are doing. And that is why Wall Street is completely and utterly obsessed with the Fed. And this whole idea was put to the test under Hurricane Ben. He led the Fed through a relentless campaign of 17 consecutive interest rate hikes, 17 of them, taking the Fed funds rate from a rock bottom 1% all the way up to 5.25%. And the market, just like our table predicted, absolutely hated it. You could almost hear the collective sigh of relief across Wall Street when they finally hit the pause button. Now, we always think of rising rates as being painful, right? And hey, if you've got a variable rate mortgage, they definitely are. But here's the other side of the coin that almost nobody ever talks about. What about savers? People with money in the bank or in bonds. All of a sudden, they were earning more interest. A lot more. In fact, that interest income was over $1 trillion, nearly double the amount of pain from mortgages. It's just a great reminder that the Fed's actions are never black and white. There are always winners and losers. And that really brings us full circle. From taking away the punch bowl to navigating huge global crises, the Federal Reserve's decisions shape our economic world in ways that can be volatile, surprising, and incredibly powerful. The history we've just walked through is a fantastic lesson in how it all works. So I'll just leave you with this question. Knowing what we know now about how this all plays out, what ripples from the Fed's decisions today will we all be feeling years down the road? You know, when you hear the word market, your mind probably jumps straight to stocks, right? The Dow, the NASDAQ, all the daily ups and downs we see on the news. But what if I told you that's just the tiny, visible tip of a colossal financial iceberg? In this explainer, we're going to dive deep beneath the surface to see what's really driving the whole thing. Let's get into it. Okay, first, let's just try to get our heads around the scale here. The worldwide stock market, yeah, the one that gets all the attention, is worth about $51 trillion. It's a number so big it almost doesn't feel real. That seems like the biggest game in town, doesn't it? All right, hold that thought. Now look at this number, $480 trillion. That's the estimated size of the world's derivatives market. So what are derivatives? Well, think of them as side bets, really. They're financial contracts whose value comes from something else, like a stock or a commodity. And at nearly 10 times the size of the entire stock market, they kind of make that 51 trillion look small, huh? So, here's the crucial point. The financial world we hear about is just a fraction of what's really going on. It's way bigger, way more complex, and way more interconnected than most people think. To really understand it, you got to look at the whole picture. The mechanics, the psychology, and all the hard-won lessons from decades of chaos. So here's our game plan. First, we're going to define what the market even is. Then, we'll peek inside the engine room to see how exchanges actually work. We're going to tackle the big myth of market rationality, learn how to navigate its crazy mood swings with some incredible stories, and then we'll wrap it all up with some timeless lessons for your own playbook. All right, let's jump in with that first big question. What exactly is the market? It's a term we throw around every single day, but it refers to a massive ecosystem of trading that goes way beyond just buying and selling company stocks. This chart really drives that iceberg analogy home. Look at this. The bond and stock markets, they're huge, no doubt, but they are absolutely dwarfed by the derivatives market. To put that $480 trillion number into perspective, it's more than 10 times the size of the entire planet's economic output. It's just a wild reminder that the headlines we see are focused on a very, very small piece of the puzzle. Okay, so with all this money flying around, how do all these trades actually happen? Let's pop the hood and go inside the market's engine room, the stock exchanges that bring all the buyers and sellers together. At its heart, a stock exchange is basically a matchmaker. It doesn't matter if it's a physical trading floor or a giant network of computers, its main job is to create a fair and orderly place to trade. And its most critical function is something called price discovery. That's the constant dance between supply and demand that decides what a stock is worth at any given second. Now, exchanges basically come in two main flavors. You've got the old-school New York Stock Exchange, a real physical place with people yelling and using hand signals in what's called open outcry. Then you have the new school, the NASDAQ, which is totally virtual. It's a massive network of computers where trades are matched electronically. One is based on human interaction, the other on algorithms, but they both have the exact same goal. Okay, now we get to the really juicy stuff. We have these incredibly complex, high-speed systems for trading, but what happens when the people using them, well, aren't always thinking rationally? This, right here, is the great conflict of the markets, the constant battle between cold, hard data and raw, messy human emotion. The brilliant economist John Maynard Keynes absolutely nailed it with this quote. It's such a humbling reminder that even if your analysis is perfect, even if you are 100% right, the market can be driven by forces that defy all logic: fear, greed, and just pure, unadulterated hype. And there is no better example of this than Black Monday. On October 19, 1987, the Dow just collapsed. It fell almost 23% in a single day. But here's the truly shocking part. To this day, no one can point to a single piece of news that caused it. There was no big event. It was just a perfect storm of panic feeding on itself. A terrifying lesson that markets can be driven by nothing more than mass hysteria, totally disconnected from reality. So if markets can just completely lose their minds, how are you supposed to navigate them? Well, let's dig into a couple of powerful stories about how to stay focused when it feels like the world is ending. It's really all about separating the signal from the noise. Let me set the scene for you. It's August 1998. Russia defaults on its debt, and sheer panic ripples across the entire globe. The Dow gets hammered, dropping over 350 points in one day. The headlines are screaming crisis, and investors are running for the hills. But right in the middle of all that chaos, one veteran investor had a completely different take. His argument was, relax, it's the end of August. All the top traders, the A team, are on vacation. It's just the B team left in charge, and they're overreacting. I mean, what a remarkably calm and contrarian view to have in a moment of pure panic. And you know, this wasn't just a gut feeling. It was a view based on solid fundamentals. The reality was, U.S. exports to Russia were a tiny fraction of the total, basically a rounding error. Big companies were ready to buy back their own stock on the cheap. And most importantly, the core U.S. economy was actually really strong, with low interest rates and low inflation. And the result? The market didn't just recover, it ended the year up over 16%. The mentor was absolutely right. What looks like a terrifying crisis turned out to be a massive buying opportunity for anyone who kept their cool and focused on the data, not the drama. Okay, now let's look at another kind of market mood. After that super fast sprint to Dow 11,000 back in 1999, the very next 1,000-point journey to get to 12,000 was an absolute grind, a brutal 7.5-year slog. It took 2,726 days. It just goes to show you that progress in the market is almost never a straight line. In fact, the mentor in this story called this the toughest 1,000 points ever. And you can see why, right? Because between those two milestones, the market had to live through the dot-com bust, the 9/11 attacks, and a pretty nasty economic slowdown. It was a period that tested the patience of even the most experienced investors out there. And that right there is the key lesson. The market's journey is long. It has these incredible sprints, but it also has these grueling uphill climbs. The real winners aren't the folks who try to time the sprints, but the ones who have the endurance to stick it out for the whole marathon. Okay, so we've seen the sheer scale of the market, we've looked at how it works, and we've seen how irrational it can be. So now let's boil all of this down into a simple, powerful playbook of timeless lessons that you can actually use. Here are the core principles. First, don't let scary headlines blow up a solid long-term plan. Second, remember that big market milestones like Dow 30,000 are just signposts on the road. They're not the destination. Third, focus on the real stuff that drives value, like a company's earnings, not whatever the hot new indicator is this week. And finally, and this one is so important, proper asset allocation, just spreading your money around smartly, is your single best defense against the wild swings. And here's one final piece of wisdom to keep in your back pocket. A great idea that's based on solid facts might not pay off right away. Patience is everything. What looks like a bad call today might just be a brilliant call that's a little bit ahead of its time. So, we'll end with this question. Every single day, the markets serve up a storm of both hard data and emotional drama. Understanding the difference between the two and choosing where you focus your attention, well, that might just be the most important financial skill you can ever have. Thanks for watching.
You know, it's easy to feel like an investing genius when the market is just going straight up. We've all been there. But what happens when the storms hit? What happens when the sky starts falling? Well, today we're building the playbook, the kind of investment strategy that doesn't just help you survive the chaos, but actually helps you use it to your advantage. So how do you stay the course when every single instinct in your body is screaming at you to panic and sell?
I love this quote because it just nails it, doesn't it? Smart investing isn't about having a crystal ball and predicting the future. It's about having a rock-solid plan to deal with whatever the future throws at you. Your strategy, that's the tool you use to turn all that market chaos and all that widespread fear into your own personal long-term win.
And that really is the million-dollar question, isn't it? When the headlines are blaring crash and every little dip feels like the beginning of a free fall, what do you hang on to? What is the one thing that actually matters? Well, we are about to unpack the exact playbook that the most successful investors use to answer that very question. Think about it like this. In the wild, turbulent seas of the market, your strategy is your North Star. It's that single, fixed point in the sky that you can always navigate by, no matter how hard the winds are blowing or how high the waves get. It is the one thing that keeps you from getting completely and hopelessly lost.
Okay, so what are we even talking about when we say investment strategy? At its core, it's really just a set of rules you make for yourself before the panic sets in. This isn't about chasing the hot stock of the week. It's a personal game plan that guides your behavior, what you buy, why you buy it, and when you sell, all based on that crucial balance between how much risk you're willing to take and the potential reward you're hoping for.
And for my money, a perfect example of a powerful North Star is the good old buy and hold philosophy. The logic here is beautifully simple. Over the long haul, markets tend to go up. Trying to perfectly time the peaks and valleys? Well, for most of us, that's just a losing game.
This strategy keeps your costs way down, and it's backed by big ideas like the efficient market hypothesis, which basically says all the known information is already priced into a stock, making it incredibly hard to consistently beat the market. The most disciplined folks take it to the absolute extreme. You never, ever sell unless you truly need the money.
All right, so you've got your North Star. You've decided on your buy and hold strategy. That's the easy part. You want to know what the hard part is? Sticking to it. Because the world is a very, very noisy place, and it feels like its main job is to constantly try and knock you off your course.
To really hammer this point home, I want to share this fantastic analogy from an old market commentary. It's called the woodshop syndrome, and it perfectly, and I mean perfectly, captures how we as investors get so easily distracted from the thing that actually matters.
So here's how it goes. You walk into your woodshop with a single clear goal: build a chair. That chair is your financial goal. Maybe it's a comfortable retirement or a down payment on a house. But then you look at your tools and you think, my saw is a little dull. So you start sharpening it. That's you obsessing over the daily moves in interest rates or the latest inflation report. Then you get another brilliant idea. I should create a spreadsheet to track exactly when I sharpen all my tools. That's you building these insanely complex systems to monitor every tiny blip in your portfolio. And before you know it, you're an absolute world-class expert on tool sharpening logistics, but you've totally forgotten you went in there to build a chair. You've completely lost the plot.
Okay, this all sounds good in theory, right? But does it actually hold up in the real world when things get messy? Well, let's find out. We're going to hop in a time machine and take a look at some real historical crises. We're going to see how the screaming, fearful headlines of the day stacked up against the quiet, simple truth of the underlying data, the fundamentals. Our first stop is 1998. There was this massive hedge fund, long-term capital management, run by literal Nobel Prize winners, mind you, and it was spectacularly collapsing. On September 29th, the Fed steps in and cuts interest rates, which is almost always a positive sign for stocks. But what happens just 2 days later? The market absolutely tanks. Why? Pure, unadulterated fear. Irrational trepidation, as one source put it. The panic completely drowned out the good economic news, but what about the people who stuck to their playbook? Well, by the end of the year, the market hadn't just recovered, it had gone on to hit new highs.
All right, let's jump forward a few years to 2002. The dot-com bubble had burst in a huge way. We had massive scandals at companies like Enron and WorldCom that just shattered investor trust. Man, the mood was just awful. And the media gave the biggest worries a nickname: Wall Street's axis of evil.
And look, these fears were 100% real. People were genuinely terrified about cooked books, about corrupt corporate boards, and about a US dollar that seemed to be getting weaker by the day. You can just imagine the headlines. It seriously felt like the entire financial system was rotten to the core. This was the noise, and believe me, it was deafening.
But, and this is the most important part of this whole story, while that axis of evil was dominating every news channel, the actual fundamentals were telling a completely different story. Here's what one analyst at the time called the fundamental six-pack. You had a helpful Federal Reserve keeping money cheap. The economy was already rebounding strongly. Valuations? Amazing companies were basically on a 50% off sale. There was no inflation to speak of. Corporate profits were already starting a huge rebound. And the big one, demographics. You had a tidal wave of 76 million baby boomers who had to invest their money for retirement. The data was screaming buy, while the headlines were screaming get out.
So this brings us to a really simple but incredibly powerful rule of thumb. When the story is confusing, when fear is everywhere, just follow the money. Where is the actual cash going, and what story is it telling you?
Get your head around this number. In 2005, while so many people were still paralyzed by the fear from the crash, the companies in the S&P 500 were sitting on $2.3 trillion in cash. That was the highest level in 3 decades. It was an undeniable sign of incredible financial strength. The companies themselves were flush.
And it wasn't just the big corporations. At that exact same time, the net worth of U.S. households hit an all-time record of over $51 trillion. The message from the money could not have been clearer. Both American companies and American consumers were in fantastic financial shape, a reality that flew directly in the face of the doom and gloom narrative.
Now, hold on. This isn't about just being a blind optimist and saying everything's always fine. A smart strategy is about being a realist. It's about objectively weighing all the evidence, the good and the bad. And just as importantly, it requires having the humility to accept that sometimes, even with the best analysis in the world, you're going to get the call wrong.
Here's a perfect real-world example from March of 2000. This was the absolute peak of the dot-com bubble. You had some serious negatives, the headwinds. Interest rates were rising, oil prices were surging, the market was already correcting. But you also had huge positives, the tailwinds, this incredible technology revolution, a booming global economy. The author who laid this out at the time weighed it all and made the call that the positives would win.
And he got it wrong. The headwinds won that round, and the market fell that year. So does that mean the strategy was a failure? No, not at all. Because the strategy isn't about being right every single time. The strategy is the process of weighing the evidence. It's the discipline that counts, not a guarantee of a perfect outcome.
Okay, so after we've learned to tune out the noise, to separate the real data from the fear, and to have the humility to know we won't always be right, what's the big payoff? Why do we do all this? Well, we arrive at the ultimate prize, the entire reason we stick to a long-term strategy in the first place, the incredible, almost magical power of compounding.
This right here might be one of my favorite illustrations in all of finance. Let's say your goal is to get to $1 billion. Option 1, you work for it. You earn an incredible $100 an hour, working 12 hours a day, 365 days a year, with zero taxes. It would still take you 2,283 years. Option 2, you start with a single dollar and you find an investment that doubles your money every single day. You'd hit $1 billion in just 31 days. Now, obviously, neither of these is realistic, but it perfectly shows the mind-bending difference between linear growth and the exponential magic of compounding.
And that, right there, is the secret sauce. That's the whole game. A sound, long-term investment strategy is designed to do one simple thing: to get the most powerful force in the universe, time, working for you, not against you. It's about letting compounding do the heavy lifting, the truly miraculous work. Look, we've seen it over and over again. The names change, the LTCM crisis, the axis of evil, the financial crisis, the pandemic, but the fundamentals of a good strategy never do. Patience, discipline, a relentless focus on the long term. And trust me, the next big scare is always right around the corner. So the next time panic is in the air, the only question that matters is this: are you going to be watching the noise from the headlines, or are you going to be looking at your playbook?
All right, let's talk about something that can feel, well, completely chaotic. The intersection of politics, government decisions, and the financial markets. It often feels like you're trying to read tea leaves in the middle of a hurricane, right? But what if I told you there are patterns in that chaos? That there are actual signals you can pick out of the noise if you just know how and where to look. So yeah, let's dive in. You know, it's funny, Groucho Marx obviously wasn't a Wall Street analyst, but he might as well have been. This quote just perfectly captures how so many of us view the world of politics. It seems totally messy, completely illogical, and when you're trying to figure out where to put your money, that's a genuinely scary place to start from. And that is the million-dollar question, isn't it? So here's what we're going to do. We're going to crack open an analyst's playbook for how to translate what governments do into what markets will do. First, we'll lay the groundwork, a simple framework for what governments are all about, and then we're going to really put it to the test with some serious real-world examples. We're talking domestic policy meltdowns, predicting presidential elections, and even massive global shakeups. Okay, so first things first, before we can analyze any policy, we need a super simple way to think about what a government's job actually is. The source material boils it all down to 4 basic areas of responsibility. Think of these as the 4 fronts. This is our starting point for everything else. And before we jump into those 4 fronts, let's just make sure we're all speaking the same language. When we say public policy, this is what we mean. It's not just one law or a single new rule. No, it's the grand total of everything a government does, and, just as critically, everything it chooses not to do that ends up affecting our lives. And, of course, our wallets. So here they are, the 4 big channels of government influence. First up, you've got military defense. Pretty straightforward, right? Protecting the country. But for us, that means thinking about defense stocks, the stability of global trade, all that stuff. Second is economic security. This is the big one for markets. We're talking taxes, interest rates, trade agreements, the whole shebang. Third, we have social security, which is basically the nation's safety net. It has huge implications for things like consumer spending. And finally, number 4, environmental security. This is about managing our shared resources, like air and water, and that touches industries from energy all the way to farming. The key thing to get here is that every single political debate, every new law, fits into one of these boxes and sends ripples, big or small, through the financial world. Okay, so enough with the theory. Theory is great, but let's see how this framework holds up in the real world. We're going to kick things off with a domestic policy case study that had absolutely massive consequences, the California electricity crisis back in the early 2000s. Man, this was a wild time. If you were around then, you remember it. Rolling blackouts across the state, electricity prices going through the roof, huge utility companies just going bankrupt. Now, the common story was that deregulation itself was the villain, but the analysis in our source material makes a much sharper point. It wasn't the idea of deregulation that was the problem. It was that California's specific policy choices literally guaranteed it would blow up. And it was basically a 3 strikes and you're out situation. Strike 1, the state let the price of wholesale electricity go wild, but they put a hard cap on what utilities could charge customers. I mean, think about that. You're buying high and forced to sell low. It's an impossible business model. Strike 2, they actually banned utilities from signing long-term contracts to lock in prices. Instead, they had to buy power on the daily spot market, which is like trying to fill up your car's gas tank one thimbleful at a time, paying whatever insane price is listed that second. And strike 3, the final nail in the coffin, they made any new company that wanted to compete pay for the old, outdated plants of their competitors. I mean, who in their right mind would do that? It was a disaster baked right into the legislation. And here's the proof in the pudding. The policy was the problem, not the principle. In California, less than 1% of people ever switched providers because, well, there was no real choice. Meanwhile, you had other huge states like Texas and Pennsylvania that also deregulated, but they did it without these fatal flaws, and it worked just fine. The market signal couldn't have been clearer. Bad policy creates bad markets. Period. Okay, so being a Monday morning quarterback and analyzing a disaster after it happens is one thing. But what about calling your shots ahead of time? Let's check out another prediction from that same time. In early 2001, the economy was looking pretty shaky. You had manufacturing slowing down, layoffs picking up. It wasn't a good scene. And based on that pressure, the author made a very specific call. The new Bush administration was going to be forced to pass some major tax cuts to get things moving again. And boom, nailed it. The prediction was dead on. The economic pain created the political motivation to get something done, and they did. Both the dividend tax and long-term capital gains rates were cut, 2 moves that have a direct, immediate impact on investors. It's a perfect example of how economic reality can often force a politician's hand. So we've seen how this kind of thinking applies to a state-level mess and to federal tax policy. But what about the biggest political game of all? Predicting who gets into office in the first place. I mean, an election year is just a deafening amount of noise, right? It feels like it's all about personalities and gaffes. But our source material tries to cut right through all of that by focusing on what really moves the needle for voters. The idea behind it is actually pretty simple. When it comes down to it, when you're in that voting booth deciding whether to keep the person in charge, you're probably voting with your wallet. It's all about your personal economic situation. So to measure that feeling, the author built this tool called the ICU Index. Now, it's not a crystal ball. Think of it more like a noise-canceling headphone. It's designed to ignore all the daily political drama and just focus on 3 economic numbers that people feel in their bones. So here's how the ICU Index breaks down. I is for interest rates, specifically the 10-year Treasury. Why? Because that's what drives the cost of your mortgage, your car loan, the big stuff. C is the Consumer Price Index. That's just a fancy term for inflation. Is a loaf of bread and a gallon of gas costing you more than it used to? And U is the big one, the unemployment rate. Do you feel secure in your job? That's it. You just add those 3 numbers up and you get your ICU score. So, the big question is, does this thing actually work? Well, let's look at the history. Over a 50-year stretch, only 3 presidents running for re-election actually lost. And look at their ICU scores when they lost. Gerald Ford was over 21%. Jimmy Carter, a staggering 32%. And George H.W. Bush was over 17%. You see the pattern, right? No sitting president had ever lost with a score below 17%. That's the red zone. That's the number to watch. Which brings us to the 2004 election. There was tons of debate. Polls were all over the place. But what was President George W. Bush's ICU score? It was just under 12%, way, way below that 17% danger zone. So, by ignoring all the punditry and just looking at the hard, pocketbook data, the analysis predicted a clear victory. And that's exactly what happened. Okay, so this kind of focus on the economic fundamentals and policy seems to work pretty well here in the US. But what happens when we take this show on the road? Does the same logic hold up in international markets where things can get even crazier? Let's take a look. Let's head back to the year 2000 in Mexico. The country was on the brink of a massive change. The prediction here was that Vicente Fox was going to win the presidency and in doing so end an incredible 71 years of one-party rule. But the forecast went deeper. It said his win would trigger a wave of specific pro-market policies, opening up big industries like energy and telecom, reforming the tax system, and building a much closer relationship with the US. And what happened? Well, at first, the market panicked. It dropped almost 21%. 71 years of one system ending. You can't blame investors for being nervous. But then, just as the analysis expected, once those new business-friendly policies started coming into focus, the market came roaring back. It was up over 12% the very next year. The political revolution was the direct trigger for that massive market reversal. All right, for this last part, let's bring it all home. We're going to zoom in on the one political issue that is pretty much guaranteed to start an argument at any family gathering: taxes. And to unpack the incredibly complex feelings around tax cuts, the source material uses this really simple but really powerful story. So, picture this. 10 guys go out for beers. Every single day, the bill comes to exactly $100. And they all agree to pay the bill the same way we pay our income taxes. What does that mean? It means the first 4 guys, the ones with the least money, they pay nothing. 0. The guys in the middle pay a little bit each, and the 10th guy, the wealthiest one, he pays the bulk of it, $59 all by himself. So they do this every day. Then one day, the bar owner feels generous and gives them a $20 discount. The bill is now only $80. So the question is, how do they split that $20 in savings? Well, they decide the fairest way is to give everyone the same percentage discount. Seems reasonable. So the 6th guy, he used to pay $3, now only pays $2. He saves $1. The 8th guy saves $3. And the 10th guy, because he was paying the most to begin with, he gets the biggest raw dollar savings, $10. Now, let's be clear about the math here. Every single person who is paying anything at all is now paying less. They are all, objectively, better off. But here's the thing about politics. It's rarely just about the math. And this is exactly where it all goes sideways. The guys who saved $1 or $2 look over at the 10th guy, who saved $10, and they get angry. It doesn't seem fair. The 4 guys who were paying nothing are even angrier. They didn't get any cut at all. And just like that, the conversation completely shifts. It's no longer, hey, great, we all saved some money. It becomes, look at that rich guy, he got the biggest break. And the other 9 guys all gang up on the 10th man. So what happens the next night? The 10th man doesn't show up. And the 9 guys who are left suddenly realize they don't have enough money to even cover half the beer bill. So the final provocative question this story leaves us with is this. If the people and the companies who contribute the most to the bill are constantly attacked for getting the biggest dollar amount breaks, will they eventually just decide to go drink somewhere else? The story connects directly to real-world business decisions, like Halliburton moving its headquarters to Dubai. And it leaves you to wrestle with the very real consequences of how we choose to talk about and act on tax policy. You know, as a strategist, I've spent years traveling the globe. And let me tell you, it's not about the frequent flyer miles. It's about seeing things on the ground, finding the patterns that everyone else misses. And what I've found is this profound shift in how the world economy works, a shift that I believe presents the single biggest opportunity for investors today. So let's get into it. And you know this quote, it really hits the nail on the head. For the longest time, investors were just worried about globalizing risk. They completely missed the other side of the coin. The world has been globalizing something very, very good: opportunity. And that opportunity is the direct result of a force that's reshaping everything. Okay, so let's get something straight right off the bat, because it's super important. These 2 words, globalization and internationalization, we throw them around like they're the same thing. They're not even close. Internationalization is just countries trading more with each other. Globalization, that's something much deeper. It's about the borders themselves starting to blur, creating a single, unified global economy. We're moving from a world of international trade to one of inter-regional trade. And if you don't get that difference, you're going to miss what's coming next. So I want to take you on that journey with me. Think of it as a world tour, from the crazy busy shipyards of Shanghai to the quiet, ancient streets of Oman. My goal here is to show you firsthand why the most important mandate for investors today is actually incredibly simple once you start to see the world through this new lens. All right, first stop, Asia. This is the absolute engine room of global growth, folks. No question about it. This is where the story of the 21st century economy is really being written. And it's a story that's full of surprises, especially in a place that pretty much everyone had given up on for dead. And this quote just brilliantly captures the story of Japan. For more than a decade, it was the market everyone loved to hate, a total lost cause. But then, in 2003, Japan started becoming the Seabiscuit of the investment world, the ultimate long shot, the underdog that was showing clear signs of a truly historic turnaround. I remember the snickering I heard when I recommended it at the start of that year. By the end, all I heard was stunned silence. So what happened? What was the big turning point? Well, it all came down to this one moment in 2003. Japan's fifth largest bank, Resona Holdings, was putting out the same old rosy forecasts they always did. But this time, their auditors simply refused to sign off. They called their bluff. That single act forced a government bailout and sent a massive signal that the days of pretending were over. It was the Big Bang reforms from the 90s finally getting some teeth. And I mean, look at how the market reacted. That one act of courage did more for investor confidence than anything in the previous decade. So then I'm in Japan, running late, and I have to hop on the bullet train, this absolute marvel of engineering that was built for the 1964 Tokyo Olympics. And as I'm flying along, it just hits me. Back in the 50s, Japan was basically a country of dirt roads. The Olympics forced this incredible infrastructure buildup that then fueled a 20-year economic boom. And I thought, my God, if you want to see China's future ahead of the 2008 Olympics, just look at Japan's past. History was repeating itself, but on a scale that was just mind-boggling. And when I say mind-boggling, I mean, just look at these numbers. At the time, China was consuming half of the entire world's cement, 40% of its steel, 30% of its coal. These aren't just stats on a page. These are the literal building blocks of a new economic superpower rising faster than anything the world has ever seen. The numbers are just staggering. Seeing it firsthand in Shanghai was just something else. We joke about construction cranes being the national bird of economic prosperity. Well, I tried to count them in Shanghai. I just couldn't. It was impossible. They were everywhere, 30 to 40 deep, as far as you could see in every direction. It was absolute proof that all this talk of a China slowdown was completely disconnected from the reality on the ground. Now, this is where it gets really, really interesting. Wall Street was totally stuck in this old way of thinking. They'd say, you have to pick. Is it Japan or is it China? They were completely missing this huge generational shift. Sure, Chinese consumers over 40, they grew up with the war stories. Maybe they avoid Japanese goods. But the younger generation, they grew up with prosperity. They don't care where the cool thing comes from. They just want the cool thing. And that demographic shift, that's the invisible thread linking these two economic giants. It's a trend that takes decades to play out, not just a few quarters. Now, this incredible consumer story in Asia is really just one chapter. As we start to widen our lens, we see these similar transformations happening all over the place. The details are different, of course, but they're driven by the same fundamental shifts, a new pragmatism, a drive for development, in emerging markets all across the globe. In Brazil, for instance, I saw a country that was just for real. While other countries were endlessly debating energy policy, Brazilians were already driving diesel and hybrid cars. It's just what they did. Their elections, mandatory, and held on a Sunday so everyone can go. Simple, right? But the most telling thing was the investor mindset. The wealthy folks in Brazil weren't trying to create new wealth in the stock market. They'd already done that building their businesses. They were investing for a return of their capital. Preservation, not speculation. It's a completely different approach to risk, one that's built on stability. And Egypt, wow. Egypt brilliantly illustrates this whole idea of development potential. In the cities, you see the now, this frantic, bustling pace of economic growth. But you drive just a little bit outside of Cairo, and you step into the then. I mean, it's like going back 1,000 years. And this incredible contrast, that's not a problem. That's the opportunity. The entire investment thesis is that the gap itself is the engine for growth. Every single road that gets paved, every power line that gets connected, represents a tangible return. Okay, our next stop is Europe. And I know what a lot of investors think. It's old, it's stagnant, its story is over, right? But what I saw firsthand was a continent that was quietly going through some profound changes, creating some really unique opportunities for anyone willing to look past the old stereotypes. In Italy, it felt like all roads were leading to change. And what's so fascinating is how you saw these three completely different clues in politics, religion, and finance, all pointing to the same conclusion. Italy was breaking from its past. You had a new political guard, you had a modernizing Vatican, of all things, and you had the stock exchange opening itself up to the world. It's a perfect portrait of a classic value play, where the old tired perception is masking this deep structural change that's happening right under the surface. And then in Sweden, I found a new ABBA that was performing incredibly well. And no, not the band. An economic one. A for automobiles, with global brands like Volvo and Saab. B for the massive boom in commodities like iron ore and timber. Another B for its extensive social benefits. And the final A for Absolute Vodka. It's this powerful mix of high-tech industry, natural resources, smart social policy, and global branding that creates this incredibly resilient hybrid economy. So, we've toured the globe, we've been through the engine room of Asia, the dynamic emerging markets, the quiet revolution in Europe. But for our final stop, we're going to journey a bit off the beaten path, to a small country in the Arabian Peninsula, because this is where I stumbled upon the single most important key to unlocking the potential of everything we've just seen. I mean, after traveling the world and looking at economies from every possible angle, you'd think the secret has to be some kind of complex formula, right? A hot stock tip, a specific country to bet on. But it's not. The real secret, the principle that underpins all of this, all successful long-term global investing, is something much more fundamental, much more human. I was in the city of Salalah in Oman, and I visited the tomb of the Prophet Job. And just standing there, it all clicked into place. The secret isn't complicated at all. It's patience. In a world that is obsessed with this quarter's results, the greatest advantage you can possibly have as an investor is the patience to let these incredible global stories of reform, of generational change, of development actually play out. It's about having the patience of Job to see the long-term value in a very short-term world. So here's the bottom line. The transformations that are happening in Japan, China, Brazil, Egypt, Europe, these are not quarterly stories. These are decade-long shifts. And to succeed, you have to arm yourself with that patience. You have to look for these stories of change. And you have to remember the single most important investment mantra for the 21st century: go global. The opportunities are absolutely out there for those who are patient enough to find them.